You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live every Friday at 1:30 p.m. Central, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means it's time once again for TWIFO. This Week in Futures Options, a program where the name says it all. We break down the week that was and indeed still is from a futures options trading and trending and analysis and unusual activity and volatility and skew and all those fun perspectives. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. Hope you guys are liking the new TWIFO time. Been doing it for a few weeks now here, close to a month. Used to be Fridays at 1:30 p.m. Central. Now I moved it up a day. Thursday, 1:30 p.m. Central. It means you get the live stream, obviously, earlier. Also get the podcast out earlier, which I think a lot of you guys like out there. So join us Thursdays, 1:30 p.m. Central. If you can, we'd love to see you in there. And joining me on the old program today, my usual cohort, my stalwart partner through the world of futures options, Mr. Nick Howard from Bantix, taking a much-needed, much-earned vacation this week. He's, I'm not sure where he is. I think he's out back east doing something fun, I hope. So joining me, he's been in the CME hot seat before. We thought that was a little uncomfortable for him. It's a very uncomfortable chair. It's got the spikes and things kind of like the Iron Throne. So we thought we'd bump him up to a full guest co-host seat for this episode. Our old friend Uncle Mike Tosaw from St. Charles Wealth Management. He of silver collar infamy. Mr. Uncle Mike, welcome back to TWIFO, sir. It has been quite some time.
Always excited to be here. Love this is probably my favorite show title on the entire network. This week in futures options. How about that?
And you know, it just says it all, right? You can't look askance at it, sir, because it summarizes, if nothing else. You know what you're getting when you see that title.
Absolutely.
We looked into licensing this week in baseball, and it was just too much. Nick really wanted it, but I think it was beyond the scope, the budget of this program for just every use. But it would have been cool. All right, and also joining us from the land of FTSE Russell, literally this time because they're out there in Seattle at the HQ. First off, we are joined by my other stalwart compatriot here on the program, Mr. Sean Smith, the Managing Director of Derivatives Licensing over there at FTSE Russell. And Sean, you brought yourself a guest today. You brought our old friend Ron Bundy, the CEO of Benchmarks for North America at FTSE Russell. Gentlemen, welcome back to TWIFO.
Thank you very much, Mark. Thanks for having us on.
Thanks, Mark. It's good to be back for another show. Looking forward to it.
So what brings you out to Seattle these days? What's going on in the HQ out there?
So we've got offices globally. Seattle's one of our big offices that we have clearly from the Russell heritage. So we are here seeing some clients, have some big brainstorming sessions on derivatives and our derivatives business that Sean's leading. So it's been a good few days so far.
Well, I'm glad to hear it. Let's dive right into it. Since we got you guys on, let's dive right into the deep pool that is equities and all things equities these days. It's been an interesting, tumultuous period for equities. You know, Sean, you and I have talked a number of times, about a lot of different things going on in the equity landscape. You guys are obviously look a lot at Russell because that's your baby, and the Russell 2000 has kind of been blowing the doors off just about everything else out there in terms of net raw performance. In terms of the last, few weeks, it's been kind of interesting. It's been kind of a tumultuous period in the markets. We saw a lot of earnings volatility being reflected in the markets and some sell-offs, and then, of course, in the last week or so, we've seen really just markets back in bullish territory, post some good numbers coming out of big names like Apple and Tesla and a few others, really helping to just bolster the markets going forward. Today, of course, as we're recording this a little bit past 1:30 p.m. Central here, we're seeing the markets kind of settling into a bit of a mixed period. S&P almost literally unched. The tech-heavy NASDAQ up ever so slightly. We're seeing the Dow pretty much unched on the day, and we're seeing the Russell 2000 kind of leading the charge up about 0.5% or so in that range. So kind of what we've been seeing for a while now. Russell kind of outperforming to the upside. The rest of the indices kind of mixed or doing their own thing. It's been an interesting time frame. For you guys, Ron and Sean, you guys spend your days all day with the indexes. Has this been kind of an interesting period talking to clients, I would think, because this last couple of months, more than any other period that I can remember in recent market history, we've seen each of the indices kind of, as I refer to it, kind of playing to its own base, kind of, doing its own thing. I wouldn't say independent of the other indices, but kind of moving to the beat of its own drummer. Has that been something you guys have been talking about a lot over there in index land? Is that something that your clients are picking up on as well?
Yeah, definitely. Mark, this is Ron. So what we're seeing is, on the Russell 2000, for example, it is a different index than the large cap indexes that are in the market. The Russell 2000 is a great reflection of the U.S. economy. The revenues associated with those 2,000 small company stocks are much more domestic in nature versus some of the really larger multinational companies you'd see in the Russell 1000 large cap index, for example. And so with the strength of the U.S. economy and the tax policy of the current administration really helping those smaller players in a significant way, we're still seeing a lot of movement and a lot of good momentum in those Russell 2000 small company stocks.
Yeah, it's been fascinating to watch. Kind of and it's interesting stuff. You guys, I mentioned before. By the way, I forgot to mention top of the show. You can follow along. We'll get into all the options activity in a couple of seconds, and of course, you can follow along. Generate your own reports over there. CMEGroup.com/TWIFO TWIFO. You can see all the reports we're going to look at here for all the products in a couple of seconds. I mentioned before, you guys have a lot of interesting data coming out of FTSE Russell, and coming into the show, you guys put out some interesting stuff. You mentioned the Russell 2000s, also, of course, the Russell 1000, which is really the big, larger cap names. And some of your research team, looking at the numbers coming out for July, I thought was kind of interesting. They were kind of breaking down what performed, how everything performed over the month of July. And they have, the FTSE Europe, UK, without UK out there, doing about 4.1% to the upside, kind of leading the charge. Then the Russell 1000 up there with about 3.5% upside. This again for the month of July. FTSE Emerging Market Index 2.7% to the upside. Then gold off about 2.3% for the month. The Chinese currency versus the dollar there off nearly 3%. Copper taking on the chin, off about 5%. Oil off 6% for the month, 6.3%. And then the FANG stocks bringing up the bottom there, down nearly 7%. It shows you just how important those kind of those big names, the Facebook, the Apples, all the other stuff, Amazon, really are to the market these days. In fact, your research team also went the extra mile, and they pulled out the FANG stocks out of the Russell 1000. They looked at them separately, and if you look at the Russell 1000 kind of sans FANG stocks, it's up about 5% for the year, so it's doing well, but it's the FANG stocks themselves are up about close to 30. At least they were until the sell-off began about a few sessions ago. So it's been just shows how important these big names are for index performance going on over here. Mike, you and I have talked before on the show. I know you do a lot of S&P, and that's kind of where you do a lot of your equity playing. Since you've been on the show, we talked a lot of Russell with you since you've been on the show the last few times. Has this something that you're looking at? And also, you deal with a lot of clients over there. Are a lot of clients coming to you, starting to look at maybe other indices to play with for their equity exposure?
What's interesting about the Russell is that, from what I'm hearing, or from what a lot of my clients have the interest in, is that a lot of the companies that are in the Russell don't have quite as much multinational exposure. And so if you're concerned with the trade war, the tariffs, and that type of thing, the Russell may be a place to actually park some capital for the time being if you still want to have upside in the market, but you're a little bit concerned about the trade wars. Now, of course, there's another set of risks that exist with the different size of stocks that are going on, but I think one of the things that intrigues myself and a lot of other clients or a lot of people that I talk to about actually looking at the Russell at this point in time is not only just the different class or different level of stock, the fact that it has typically a much lesser amount of multinational exposure.
Yeah, that's kind of what we've been saying that for a while. I know Ron and Sean, when you guys are out there beating the drum for all things Russell, that's probably a refrain you hear a lot from the clients these days. Like, hey, maybe we kind of like that this is a little bit more insulated from these macro tremors out there. Is that what you're hearing?
Yeah, that is what we're hearing, and I think that's being reflected, in the market. And the other thing, just to add, to Mike's comments that you see in the Russell 2000 stocks, those small company stocks, is because a larger portion of their revenues are domestic, they could potentially benefit even more than the bigger companies with these tax cuts that have come into play. So the really profitable small company stocks who have more exposure to the U.S. market and U.S. revenues, could really benefit not only from the macro trends on the tariffs and things like that not impacting them as much, but on the tax side gives them more money to invest and grow potentially as well. So there's some interesting dynamics happening in that segment in the Russell 2000.
And the market speaks for itself. This is Sean. Just the performance of the Russell 2000 versus large caps is, clear. It's up 10% versus 5 and change in the large cap.
Yeah.
Well, let's look at some of that performance. So looking here right now, again, you guys can follow along, CMEGroup.com/TWIFO coming into showtime. The Russell 2000 was up about 20 net handles on the week coming into here. So right about flirting with that 1,700 level, 1695 or so here. And we're seeing as all this upside continuing out there. We're seeing vol coming off commensurately. We're seeing vol come off across the board in all the major indices. So we're seeing it in the NASDAQ, we're seeing it in the S&P clearly. A lot of people like to look at the levels of S&P vol versus Russell. And right now we're seeing the VIX hovering right about a 1075 or so, VIX cash at least. Russell vol, aka our old friend RVX, a little bit short, shy of 3 handles north of that, about 1365 or so right about 290. So that spread hovering a little bit shy of $3. So it's still fairly wide. So that means we're seeing S&P vol coming off at a greater clip than we're seeing it coming off out there in Russell land. So that spread's widening. We've seen it get down to as low as about 1.4, 1.5 or so. So it's getting quite wide. We know when that spread kind of widens out, we see a lot of people out there looking to perhaps dip their toes in one leg or the other. Let's see what legs we're actually lighting it up out here this week. It's been kind of interesting. We were talking last show. It's kind of surprisingly across the board in all the indices, Russell, S&P, and others, we saw a lot of extreme far out of the money put trading going on last week. Let's see if we're seeing that lighting up again this week here in the old Russell 2000. If you're talking equities, you're looking at where the lion's share of the action is going to be in the weeklies and the options perspective anyway. And we're seeing that again this week. Looks like near term, near out of the money puts. So week 2, about 20 odd handle all the money puts are kind of number 1 with the bullet out here again this week. OI, by the way, fairly strong, up about 4% here for the E-mini Russell 2000 options out here. Looking here for any interesting aberrant paper we're seeing going up. Some far out of the money puts, 1375, so about 300 odd handles going up out there in, what are those? Those are June. The June contract, so they're not pretty small, but still interesting enough. And also seeing on the upside, 19 quarter going up on the upside in Dece of 2018. So we've got a nice little diverse range out there when we're looking at what's lighting it up out there from a FTSE, E-mini Russell 2000 options perspective. Sean, you're out there kind of leading the charge for all things FTSE Russell derivatives out there. What are you hearing from people out there who are slinging the options? What are they up to? What are they looking to do? Why are they coming to the product? And then also, if you got any maybe hints, any interesting things you guys are working on in the derivatives land, hint RVX. I'm just going to put it out there for you. If you want to drop it to us now on the show, feel free.
Well, the options markets, is your wheelhouse there, Mark. The comments we're hearing is, through our partners at CME and CBOE, who do a phenomenal job with distribution and educating the market and selling their products, of which we are just tremendous partners of them with. The liquidity has just been phenomenal in CBOE's products and also CME's futures. Open interest is still just hovering around 600,000 contracts. The volumes at CME and their options products are actually growing as well. CBOEs are doing well. There's good tight markets there. Really, really exciting just to see that kind of hockey stick volume growth story that we're seeing since, it's been just over a year that the business has transitioned back to CME, and we're just really excited to see the growth of all sectors trading the product from institutional to retail. So it's just been a great story.
And Ron, I know you spent a lot of your days over there in the indices wing talking about the big trend still of, active versus passive, how that's kind of playing out, as well as I know in your neck of the woods, smart beta is just the term du jour. So you got anything cooking on those fronts? Anything interesting working over there that might interest our audience?
Yeah, so there's a lot going on there, and you're right. There we continue to see a shift of interest in from active strategies to more passive strategies. But Mark, to your point, the smart beta category for is kind of the smart beta is the buzzword. And a lot of those new products that you're seeing out there really are have their roots in active management. So we're seeing a lot of interest in factor and multi-factor, investing like momentum, size, quality, things like that. And you'll over time, I think you'll start to see those types of products expand from a mutual fund or an ETF into futures and options, and give investors a lot of other tools to manage their exposures. And at the end of the day, that's what we're all doing, right? Is we're managing our exposures to different segments of the market, and we continue to look for new ways to do that within a futures and options platform as well. We handle the index side of it, and then we let our friends CBOE and CME handle the derivative side of it.
All right, speaking of new products, we have to keep rolling with complexes. We'll get back to equities in a little bit when we have a bunch of our listeners chiming in with the questions. If you guys want to chime in on crude and all the other fun stuff we're going to talk about here, feel free. Ron and Sean there as well. I know it's not in the index realm, but it's a lot of stuff lighting up our audience's tapes, and a lot of people have been talking about crude yet again. It's kind of on the radar for everyone. It was kind of hovering, had a bit of some rough periods, had a bit of a sell-off yesterday on Wednesday, kind of hovering right around 7-week lows, right around coming into showtime. Is at the 67 handle, so off about 1.5 on the week, so a little over 2%, about 2.4% net on the week. Vol kind of as usual out there in WTI. Again, bit of a mixed bag. Front portion of the curve, a little bit bid up. That's mostly gamma again. And then you get a little bit farther out into the meatier portions of the curve out there, past into November and beyond. And it seems like vol actually getting a little bit robust. So maybe people pricing a little bit more longer-term volatility or coming off a little bit longer-term volatility and pricing up a little bit more in the near term, which is kind of interesting out here. Looking at the week, open interest up about close to 3%, about 2.7%. So kind of pretty much in line with what we've been seeing out there. And activity is funny. We don't see this very often. Exactly half, 50.0% of all this week's paper going up in that front month SEP contract. So again, it kind of shows how front month heavy WTI typically is. Not so much in the weeklies. Talked about that a lot here on the show. For whatever reason, the weeklies don't light a fire under people in the energy complex. And what was lighting it up was pretty much they were at the money, now in the money puts. They were the SEP 68 puts kind of dominating the tape here with about 23,500 of those lighting it up. The lion's share coming actually on Tuesday, 8,500, 6,000 yesterday, about 4,600 on the tape today. A net about 3,000 or close to it opening, so slightly opening, but as you would expect, it's kind of an at-the-money put strike, so a lot of back-and-forth trading on that strike, opening and closing. We're also seeing kind of hot on its heels, 267 puts. So exactly kind of at the money puts, doing about 20,000 contracts so far this week. Remember, we're recording this kind of halfway through the session on Thursday here. The lion's share also coming on Tuesday, about almost 8,000 going up then, and about 4,800 going up Wednesday, 3,500 on the tape today. Net actually closing a little bit there, about 4,000 and change, which is kind of interesting. So again, a lot of back and forth positioning on both of these kind of at the money strikes. Not all puts though, listeners. The bulls have some love too. The 70 calls out here doing about 17,000 contracts again Wednesday, leading the charge here on the call side, about 7,500, 4,500 hitting the tape today, about net close to 3,000 opening up on the upside. And let's jump around here a little bit as well. Got 71 calls, also interesting. Kind of a near at the money call and put strip is kind of what we're seeing there in the front month. We're going to jump around a little bit to see if we can see any other funky strikes out here. The 80 calls lighting it up in November to the tune of about 2,000 and change, 60 puts. So some farther out downside. Indices doing about 4,000 contracts so far this week. 45 puts, very pessimistic indeed. The March 2019, 45 puts doing about 1,000 and change out here. And then a little bit longer term, we've got actually 60 calls in Indices of 2020 lighting it up to the tune of 3,000 contracts. Interesting. You don't see a lot of in the money calls. It looks like a 60-70 vertical went up on Wednesday, 2,000 times. I'll have to, when I drag Nick back on, I'll have to have him dig into the blocks for me to take a look at that one. It was like went up 2,000 times on Wednesday and 1,000 times today by itself. That's the vertical 2,000 times on Wednesday, and today just 1,000 of the 60 calls. So maybe they're rolling a little bit down there as well, which wouldn't be that surprising. But still, into an in-the-money strike. That's interesting. Interesting choice there. Mike, I know you watch a lot of energy. You look at a lot of diverse different products. You look at WTI. You also look at XLE and a bunch of other things. What's catching your eye out there from a crude oil and just an energy perspective these days?
Well, looking at the energy, we're kind of in a unique time right now in that we have I guess it's not super uniqueness of the craziness in the Middle East. I guess you could probably say that at pretty much any point in the last 50 years and be accurate. But overall, over the last few years, ever since we started getting all the extra oil from North Dakota that we had not had in years past, oil is kind of in a different world these days because it's not just a Texas thing. It's not just a Middle East thing. It's we have another player that's involved in it. And with that, in looking at crude over the course of the last year, just seeing the lows around on the 45, but I'm still a bull on it, and not necessarily because of the fact that, well, obviously not because of the fact that we have the extra player in with North Dakota, but I'm a bull on it from the fact that I believe we're going to have more demand for oil because we're going to have more need for it, because I personally believe we are in an expanding economy. And when typically you're going to need more oil for that reason, and with increased demand, it's going to be higher prices. Now, of course, the bear case for oil is, if you look at where the highs were in the 2012, 2013 era, we're still down quite a bit from there, and we haven't come back to that in a while. But I really believe that this is going to be, as the markets go up, and for those of you that typically don't listen to, or that don't listen to our other show, I'm kind of bullish on the markets typically. Longo has some interesting names that he calls me because of my bullishness on the market. But I believe that as the market expands, I believe that oil is going to come up with it. And we're positioning ourselves in such a way with energy stocks.
Yeah, we're looking at some data coming out of this week. Kind of, it's always an interesting push and pull with the data, as you kind of alluded to. We got the EIA reporting crude supplies dropping less than expected. So that's interesting. Gas and inventories, bit of a build there. Also, Chinese data showing their imports of crude dropping. So, there's always been this talk about Chinese unquenchable demand for all of our raw materials and products, and if that's kind of slowing and ebbing a little bit, then maybe that's not so much in the bull camp for crude. So a lot of interesting things, and of course, as you mentioned, the ongoing saga that is pretty much any day of the week, some tensions in the Middle East are going off. So that's there's always that premium, I think, kind of factored, and maybe a little bit higher now than there has been of late, but still, that's all these things kind of pushing and pulling. We had Blue Putnam on from CME last week. He was talking about the issues with getting a lot of that shale oil out of some of these areas because they've kind of maxed their distribution and pipeline capacity. So they can pump all they want. They can't ship it all. So there are some interesting issues that the market is kind of impacting right now from a structural standpoint. And an interesting one to watch, crude vol, all the crude has been kind of very fascinating of late. And I think we'll obviously here on TWIFO, you can't do an episode without talking crude because it's an interesting thing. Mike, I know you made an interesting comment earlier on our network, and it kind of caught my eye. I know you're a big metals head, and I know you love your silver collars and everything else. You made an interesting comment, kind of caught my ear earlier on our network, where you said that silver comes like a thief in the night. What exactly did you mean by that, sir?
Well, in looking at it, if you bring up a 20-year chart of silver, a silver chart even back to, say, 2006. So let's look at, I'm just taking a random sample here. If you go back to roughly 2006 and you look at silver, but you take away around 2010, like maybe May of 2010 until, let's just say, July of 2013, you have a very flat chart in that it really hasn't moved that much if you were to do that. However, during that span, and when we had the peaks of silver in about April of 2011, it went up really fast. In that my thief in the night comment is that all of a sudden silver is putting you to sleep, and then you wake up and silver's all of a sudden tripled one day, it feels like. And so oftentimes, and I am a silver bull for the long haul, and we talk about that a lot on the Option Block show. But with it, our holdings are along the lines of that we believe silver is going to go higher for the long haul, and we hedge it in various ways, with which we can definitely talk about on this show as well. But it's not a trending instrument. If you look at the S&P 500 over the last 20, 30 years, you'll notice an uptrend. Of course, you'll see the blips of the downtrend and the dot-com bubble, as well as 2008. But overall, it's more of a trending instrument. Whereas if you look at silver, it's more of a channeling instrument. And I think if you are a long-term bull on silver, which I am, you need to have some type of a plan in place as to when to get out. Now, what we did, and we talked about even on the shows back in the 2011 era, Option Block, I was actually more into gold at that stage of time. But similar concept, we did a lot of collars on it. And we still are doing various hedging techniques right now to this day. But I think that you need to be able to get out at a certain time frame. So yes, I do believe it's a good buy and hold investment in general, but you need to be a little bit more active if and when it comes like a thief in the night, like it did back in 2011.
Always one for a colorful analogy, sir. I can always rely on you for that, if not else there, sir. I'm looking here at silver right now as we're talking. We don't get a chance to break down silver too often on the show. Nick's a gold bug, but you're more of a silver head. I like it, so it gives me a chance to mix it up a little bit. The werewolves don't like it when you come on because we talk a lot of silver. Silver obviously doing less paper options-wise, listeners, than gold is kind of just the way these things break down. By the way, if you guys are playing along, cmegroup.com/TWIFO, head on over to that drop down, the top left corner there, select the product category, select metals, then of course go on over to silver. You can see exactly what we're talking about here. Silver on the week, kind of unched right now. Not a lot really going on, as Uncle Mike was kind of alluding to. Vol also kind of a mixed bag, kind of up a little bit, kind of down in some terms. So kind of all over the place out here from a vol perspective. Open interest up pretty strong this week, about 3.6%. So a pretty decent week. But interesting enough, Mr. Uncle Mike, the big trades of the week out here they're twofold, really. Because again, silver doesn't do a ton of paper out here, listeners, but we got the SEP, what is that? SEP 16 calls, so a little bit near out of the money calls, doing about 2,200 contracts so far this week. How's that breaking down? Pretty much the lion's share on Tuesday, 1,400. The rest kind of piecemeal throughout the week. But then right behind it, Mike, are the Dees 2019 30 calls, doing about almost 2,100 contracts. So hot on its heels, the close number 2 contract, Dees 2019 30s. How do you feel about that, Mike? That's kind of, you like long-term silver. You got that long-term 2-year collar. It's like someone maybe feeling a little bit of long-term silver love like you.
What's not to love? What's not to love? But yeah, Dees 2020, I mean, that's definitely a long ways out there. That's actually further out than we're hedged at this point. But definitely, I like longer-term option plays on silver, longer-term hedges on silver in general, just because of the reverse skew that exists in the option world. A lot of opportunities open up that way. If you believe silver is going to go up, but if you're concerned with it going down like a thief in the night as well, then there's a lot of opportunities and a lot of things that you can do in the collar world that can help you with that.
As we're talking metals, I know Mick would be all upset if I didn't at least toss a little bit of love for the gold bugs out there. So let's see what's going on in gold. Lab gold continuing kind of to erode to the downside, off about 5 handles this week, or about 0.25%. Not a huge move, right around 12.15 right now. Gold vol though, maybe that puts a smile on your face, ticking up a little bit. It's been in the toilet for so long, we've kind of stopped really commenting on it because it'll get a little bit of a blip like it is right now, and then next week it'll be coming back, crashing back down to earth. So it's kind of hard to get too excited about any blip in gold vol, but that said, there is a modest blip going on right now if you are indeed so inclined to check those out. Open interest strong this week, up about nearly 5%, 4.9%, which is kind of interesting. And the lion's share of the paper actually coming this week in actually Dees 2018 with about 25%. Very scattered paper this week, which is kind of interesting. And the big trade of the week, let's see out here, and the shiny stuff, are the 1275 calls in Dees, doing about nearly 5,000 contracts, 4,700 or so. Pretty much all of that coming up yesterday. Pretty much all that opening, 4,553 going up yesterday, and pretty much all of that opening. So a lot of upside, 1275s. Also the 1270s going up on Wednesday too. Looks like maybe there was a 1275 spread, but the numbers don't really line up. 3,500 of the 1270s going up on Wednesday as well. So it could be a funky $5 wide ratio vertical. That would be an interesting vertical. I'm not sure that $5. I'm not sure if that's where you want to go. But hey, it'd be an interesting. We've seen stranger trades, certainly, out here, particularly in metals. We've seen some very funky upside stuff in metals. 1210 puts also, again, out there in Dees, doing about 3,500 contracts. So Dees is kind of where all the action was. Also worth noting, number 4, 1180 puts, also in Dees, about 3,400. And then around our top 5, actually front month here, SEP 1,200 puts, doing about 3,200 contracts. The lion's share actually coming on Monday for those. Actually, no, I'm sorry, Wednesday, 1,500. So half of that paper almost coming on Wednesday. So interesting kind of diversity of paper out here in gold this week. 1,200 puts in June, also very active. June 2019 got 2,500 of those on the tape. It's like a 12.5, 1,200 vertical went up on Wednesday, 2,000 by 25 times on the put side. So interesting. Ratio verticals going up everywhere. interesting strike selection, a lot of interesting stuff going on. Metals, particularly gold, always an interesting place to watch things like skew changes, interesting funky verticals, and of course the ever-present gold bugs who just will not let go of any of the upside out there in metals land. Someone wrote into mentioning about platinum to us, and platinum's kind of taken on the chin. Some of the articles using boxing analogies that if the other metals are down, platinum is on the canvas, it's out. So not a good time for a lot of the precious metals out here these days, which is kind of interesting. Let's move on really quickly. Touch on the ags because you kind of have to. It's required by law these days. The beans have been kind of ground zero for the trade wars, and they continue to be interesting. They also continue to be, it looks like they're kind of pretty much about unched from where they were this time last week on Showtime, right around 890. They were threatening to break through to that 900 level and beyond, at least this time right now. As of Showtime, they could not sustain anything north of that. They're back around 890 again. So beans bulls happy probably that they bounced off those extreme lows we saw during the trade war, but still not quite quiet. Vol also up across the board, except for some of the longer terms coming in a little bit vol-wise, but for the most part, vol up and up pretty strong, despite the fact that the beans are kind of net unched on the week. Open interest kind of slight this week, so maybe the beans are quieting down a little bit. 2.5% up open interest here this week. And in terms of, we say right around the 890 handles where we said we're sitting coming into Showtime here. Half of the paper this week coming in that November contract, 52.5%. The 920 calls, so near term, slightly out of the money calls, dominating the landscape here for soybeans. So near term bulls looks like they're leading the party. Let's see how that broke down throughout the week here. The lion's share on Wednesday, almost all of that, 6,200 coming on Wednesday. And a lot of that was closing, actually. About half of that paper was closing. So looks like people perhaps giving up some of that near-term ghost, maybe thinking they were hoping for a sustained rally north of 900 when we didn't see it, coming in and closing out some of that paper. Also seeing a lot of action on the par calls, the 1,000 calls. Remember, we had just broken through that to the downside back a few months ago when we had the Acuna guys on. We were talking about a good deep dive into ags. People were wondering how deep that sell-off through the 1,000 level would go. Now we know. Down pretty far south of that. So about 7,000 of the par calls going up this week as well. Looks like maybe a bit of a vertical going up there as well because about 4,500 of them going on Wednesday as well. Wednesday was a big day out there for beans. Upside again, a lot of those closing as well, 1,500. So Wednesday was a big day for closing upside north of the 900 strike in the beans calls, it seems like, which is intriguing in and of itself. 9.5 calls, also doing about 6,000 contracts, pretty active out there as well. Some puts 860, 800, 840, kind of the rounding out our top, at that point 6, doing about 5,000 to about 4,200 respectively each. Just look at some weird outliers if we can. Really, 1180 calls getting a little bit of love here in, in July of 2019, 1,200 contracts going up, 1,000 on Tuesday, 218 on Wednesday. That's all that opening. So there is some opening positioning to the upside. It's not all closing, but still interesting stuff here in the beans. Really quickly, some of you hit us up with this this data coming out, I believe it was Bloomberg, talking about the ags. And just in general, they had a nice visual representation. I'll try to put some of this in the show notes of just how our agricultural land is actually used in the U.S. Overall, just net land mass wise, ag land devoted to agriculture uses takes up about a fifth, about 20% of the land we have in the country. The actual land used, though, to grow actual crops that we eat, that's much smaller. It's only about the size of, they term here, Indiana, Illinois, and half of Iowa combined. So if you can kind of picture that weird melange of states, then that's what it is. More than a third of our entire corn crop devoted to ethanol production. So that won't surprise any of you who follow these products. And the most of our cropland is actually used for livestock feed or exports, or again is also left. They have to let it rotate a bit, so that's left idle to let the land recuperate here. So interesting factoids coming out of Bloomberg here, which is interesting stuff. Really quickly, just some import data here. Let's keep on rolling. Oh, by the way, 1/3 of U.S. land is used for pasture, which is a fascinating thing. And 25%, that is administered by the federal government. Who knew? We can get it knee deep into all sorts of fantastic ag visuals, but we got to keep on rolling really quickly here before we get to some of your questions. Let's break down our movers and shakers of the week. These are the hot, big moving products, the big movers and shakers over there that are listed on the CME group. Again, this is just pure underlying futures performance. There's no volatility. There's no options open, nothing like that. Just straight up what's moving and shaking out there this week. And the upside here, our top 5, Oats, number 1 with about 7.7% to the upside. So good week for Oats. Number 2, again, this is just for the week. Number 2, the Nat Gas up nearly 5%, 4.83%. Number 3, iron ore up about 4.4%. Lean hogs, our old friend Lean hogs, up about 3.5%. Round out the top 5 of the Eurodollars, up about 1.63%. To the downside, we've got rough rice just getting wiped out here. Off, looks like about 8% exactly. Number 2, WTI, again, not a great week for WTI, off about 4, almost 5%. We've got RBOB off about 3.25%. Number 4, lumber off about 3.15%. And rounding out our bottom 5 here is palladium, actually off 2.15%. Now, Mike, Ron, and Sean, I hope you guys put on some of your question answering pants because it is time for our futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/theoptionsinsider, stocktwits.com/optionsinsider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody, welcome to the Futures Options Feedback. You guys know the drill. You ask questions, we answer them. We try to get to as many as we can here on the show. Ron and Sean, you guys are first up here. Looks like we got going back to the realm of equities with this first question. This comes from listener Dolamite. They want to know, what is the best way to harvest the higher levels of volatility in the Russell 2000? This is, probably a common question you guys probably get a lot over there because, we've seen a lot of data. We've talked about it many times on this show. Structurally, Russell 2000 is a very volatile, much more volatile product structurally than the S&P and a lot of other indices because small caps by nature, more volatile. So that makes sense, of course. There's a lot of interesting ways we could skin that cat. Probably easily spend the rest of the show talking about that. But before we even get into that, Ron and Sean, is this a use case you're hearing a lot from your audience out there? People coming to the Russell and trying to use it to try to harvest some volatility at a time when maybe it's harder to find in other indices? It's
historically it's been a more volatile index, right? And that has been shown reflected in the options markets with the skewness of the downside. The puts have always traded rich to other index options. Ways to harvest, like we can't give you any kind of trading guidance to the person that asked the question. Unfortunately, this is where I really miss Nick Howard to kind of talk put spreads and the other strategies that he's so well versed in these products. So, but we'll just leave it at that. We know there's tremendous opportunity in trading things like put spreads to harvest that skewness and taking advantage of that volatility in the markets. But as you know, the volatility has come in quite a bit due to the performance of the Russell 2000. You actually mentioned the spreads at like 290 between VIX and RVX right now. And it's starting to widen, but that's because of the drop in volatility of other products. So, which is healthy. And again, I can't really give direct trading suggestions at this point. Sorry.
No fun, sir. No, of course. We're just pulling your leg here. But, I'm looking here right now. I'll hop in the Nick seat because he's Mr. Quick Skew and everything. And this is, of course, data you could get from looking at Quick Strike listeners. So head on over to cmegroup.com/TWIFO or head on over to bandtix.com. Kick the tires on the free trial there for yourself. One of the most common ways to harvest any sort of volatility premium in any equity or index is the simple put and put spread to the downside selling. We probably lean more towards put spreads here just because it's a more risk mitigated strategy. If you just naked blasting out puts, it could sometimes come back to bite you. People usually do those, shall we say, in somewhat overabundance, and then it leads to bad things happening. So we like to counsel put spreads whenever possible. That's kind of the most basic way, and you could do that across the broad spectrum of Russell products out there. You could do, of course, the Russell 2000 options over there at CME. There's a bunch of ways you could harvest that. I have listed options on Russell 2000. You could use those to harvest. Probably the most basic, easiest thing for people to wrap their heads around. If you're don't have the underlying, of course, you could use that as a way to leg into long underlying as well. So an interesting kind of combo there. We can get all sorts of others. There's all sorts of spreads we could do. People like to trade the spread of vol between the S&P E-mini and the E-mini Russell 2000 as well. So there's a lot of ways you can do that, during straddles and all kinds of vol spreads. We don't really have enough time to go into all the myriad ways that you could harvest that. So we'll keep it simple here in terms of near-term out-of-the-money downside put harvesting is probably the most obvious way to go. Looking at the quick skew here, it does seem like you're not getting quite as rewarded for that in the Russell 2000 skew as you were a few weeks ago. The puts were a little bit richer to the at-the-money, about 20%. Back a few weeks ago now, or about a month or change ago. Now they're coming in a little bit now. So that put vol not quite as rich. At the money vol obviously down as well. So we're seeing not quite as rich there. The calls are also looking ticking up a little bit there. So maybe you can get a little bit of love if you want to do some overriding there. But in general, dive deep into that quick skew tool. That's kind of the one you're going to want to use, because especially in equities, when you want to look at the skew before you're harvesting. Uncle Mike, you've been known to do a little bit of premium harvesting, and usually in the S&P, not so much in the Russell. But if you had to go about it in the Russell, do you have a preferred methodology, sir?
Yeah, I'm typically more of a fan of selling a vertical. What I like doing is, even whether it's the Russell, the S&P, or whatever, but the thing that I like about selling put spreads is that what your worst case scenario is going to be. If you are selling short puts without another leg to hedge it, then one of two things needs to happen. One, you need to have 100% of the maintenance available in your account, assuming the Russell were to go to zero, which there's something to be said for that in the equity world in terms of doing a wheel trade, or you need to have the maintenance set up to where you know where you're going to get out of it should it go against you. So, for example, if the maintenance requirement isn't very high, which a lot of times that's the case in the futures options world, you can sell puts and only have maybe, in some cases, 5 to 10% of the underlying as your maintenance requirement when selling a put. And oftentimes what I've seen traders in the futures world futures options world through the years do is make the mistake of thinking, okay, I'm going to sell this far out of the money put, and I'm going to get, I only need to have maybe a 5% requirement on it. I can get this much. I can get a 20% rate of return so long as the Russell doesn't go down 12% in a month. And I'm just making up numbers right now, so I don't know if that's actually the case right now with current trades. But people think things like that, and it works great. It works great for months and months and months, and then people think about how smart they are, and they just get smarter and smarter the more money they make, and then all of a sudden, that 1 month where we have some type of a crazy event, like we did in late January, early February this past year, then all of a sudden, not only are all their profits wiped out for the last 24 months, but then a lot of their initial capital is going to be gone as well. So I tend to prefer just doing a put spread. Yes, you do have to pay money to actually buy the hedge leg of the spread, but it avoids a lot of unnecessary surprises that could easily be avoided.
I'm with you there, sir. That's definitely the way I like to proceed and the way we typically counsel here on the old network. All right, let's see what else. Let's see what else we got in store for us here. Oh, Mike, since we're talking skew and things like that, and you're Mr. Metals, it's a perfect one for you. This comes from Leevy, perhaps. They're saying, is this a favorable environment for metals callers? They're looking mostly at gold and silver, not copper or industrial. So, Mike, that's when I think metals callers, you're my go-to guy. How are they shaping up out here these days?
It's pretty interesting. So right now, I was just looking at, just to prepare for the show today, right now, just in SLV alone, you could actually buy the underlying for roughly $14.50 and do a conversion for 323 days. And you could actually get a conversion. What that means is that you're buying the at-the-money put, which would be $14.50, selling the at-the-money covered call for roughly $1.16, $1.17, depending on what your fill is going to be. And I'm doing the math on this, and for 323 days, so long as, and this doesn't factor in pin risk, so you got to have the ability to handle that should it be right at 1450 at expiration Friday in January. But right there, it gives you a 2.8% rate of return, so long as the underlying is still in existence in 323 days. And I took the time to annualize that. That gives you roughly a 3.15% realized rate of return. Current CD rates right now are, and this was the highest one that I could find. I was just looking before the show on bankrate.com. I found one for 2.5% for 1 year, and you have to hold it for 12 months. Now, that's kind of exciting to me, but this is what I thought was really exciting in the skew that exists in the metal world. You could actually go long the underlying and then buy a 15.5 put, sell a 15.5 covered call, and you can do that for pretty much even money. And this is and I just did a couple of random ones because I figured we'd be talking about this on the show today. That gives you the ability to pretty much have no downside risk because you're buying the at-the-money put and having it financed by an out-of-the-money covered call. That gives you the ability to have potential upside of roughly $1 in silver. Now, with that means that over the course of rough 11 months, actually a little bit less than that, you have the ability to make 6.8% if silver were to go up $1 with virtually no risk, no downside risk, I should say. There's always risk of your broker going belly up and that type of thing, which is very minimal. But with no downside price risk, you have that ability to get a potential of up to 6.8% within a 323-day period. So to answer your question, I think it's a great time to be playing around with collars and the metals, and those are just a few that I came up with by just doing some research to contribute to the show.
Well done, sir. Well done indeed. Unfortunately, that music means we've come to the end of yet another. There we go. Come to the end of yet another episode of All Things TWIFO. Let's see if we can get... Oh, there we go. There we go. All sorts of crazy stuff happening here, listeners. Let's see if we can get back on really quick with our buddies over there, all the way out in Seattle. The connection to Seattle is kind of wonky. Sean and Ron, are you guys there with us?
We are back.
There you are. All right, I thought we had you there. So before the Skype gods stop smiling upon us again, if listeners are intrigued about what you guys are doing over there at FTSE Russell and the indexing, where should they go? What should they do? And also, you guys mentioned you're kind of putting your heads together on some new interesting derivatives initiatives. Anything you could tease us with coming down the pike?
So that's a good question. We're always looking at new ideas and new ways to bring tools to the market to help investors manage their exposures. So if you take a look at some of the really popular products out there today, like the Russell 2000, that's definitely exposure on small caps. So we're talking to our industry counterparts about other types of exposures that might be suitable for a futures or options type vehicle. Nothing specific that I can share today, but as you look across the smart beta schemes, those are the types of strategies that are getting a lot of attention today.
There you go. If you want to learn more, some of that research I mentioned at the top of the show, breaking out the FANG stocks versus the Russell indices and other things, check it out, FTSERussell.com. And, of course, you can always give them a follow while you're there on Twitter, at FTSE, FTSE Russell, over there on Twitter. And Uncle Mike, sir, you're always cranking away interesting new things. If our listeners are intrigued by these metal collars you're always slinging over there at St. Charles Wealth Management, where should they go? What should they do, sir?
By all means, contact me. Check out my website at www.stcharleswealth.com or give me a call, shoot me an email if you would like to work with an advisor who's not afraid of the word derivative. And in about another month or so, we'll be announcing it on the option block as well. But we're going to do some in-person presentations again. Now with the summer season over, the kids back in school, let's talk some options.
Let's do it, or I should say you should do it. Head on over to St. Charles Wealth Management, hit up Mike, and see maybe if you live in the Chicagoland area, you can even go up there and see him in person for some in-person meetings. Now, on behalf of Uncle Mike and Ron and Sean from FTSE Russell, and even our old buddy Nick out there having his fun vacation from Quick Strike. Check him out, by the way, if you haven't done so already. What are you doing? You're listening to the show. We use all that data throughout the show. Bantix.com. That's BANTIX.com. Click on that blue. Check out the Quick Strike trial right there. You see all this data we're talking about here and a whole ton more. So get on over there. If you're trading these products, I really literally don't know how you're doing it without that platform because it's kind of the only game in town when it comes to analytics. There's a reason why CME has integrated them into everything on their site because they make a lot of good stuff. So Bantix.com. Click on that Quick Strike link and you'll be good to go. And on behalf of Nick as well, and indeed myself, I want to thank all of you out there for downloading, streaming, and subscribing to the show and for sending in such great questions. Keep them coming. And we'll see you back here next week for more of This Week in Futures Options.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.